All right, so this is the W.M. Wrigley Jr. Company Capital Structure Evaluation and Cost of Capital Project performed by Jen, Sophie, and Carlos. We're going to give you a brief overview. So, the background for Wrigley is that they were once the largest manufacturer and distributor of chewing gum. They are in the branded consumer foods and candy industry, which is basically dominated by a few large competitors. Current market value is at 13.1 billion. They have assets of 1.76 billion and they have no debt. Uh, Credit rating of double B or B. The last 2 years, they've had revenue growth of 10% with earnings growth of 9%. Currently, there are 232 441 million shares outstanding. They do own 21% of the common stock and 58% of the Class B common stock. Now, Aurora Borealis LLC is headed up by Blanca de Brennan. She's an active investor strategist. She targets firms to for capital restructuring. She has tasked Susan Chandler, one of her associates, with the responsibility of researching Wrigley. They've come to a conclusion that Wrigley can take on $3 billion in debt to increase firm value. Now, the capital structure decision currently, Wrigley has no debt. They can basically make a decision to continue with no debt, but they do need to consider the cost and value of not having debt. They can repurchase stocks, assuming they take on the $3 billion of debt. They can use that debt to repurchase stocks. Or they can issue dividends. Now, Wrigley can redistribute the $3 billion in new debt in the form of dividends. Some financial principles to consider: agency cost. There's currently no debt capital structure, basically creates slack. And then if you did add new debt, it's going to add interest payments, which would basically help to reduce that slack that is currently in play. Now, the financial distress is going to add some fear of financial bankruptcy potential. And that's a result of the interest debt payment obligations that they'd be taking on with new debt. Capital structure theories: we've got optimal debt, which is also known as the trade-off theory. Now, de Brennan and Chandler suggest that the $3 billion debt for Wrigley is optimal. Wrigley is currently unlevered, so they're looking at getting some leverage in there for Wrigley. And obviously, the goal is to find a debt level maximizing profit that also minimizes the weighted average cost of capital. Now, capital structure theories that are at play: signaling, which basically the use of debt for paying dividends signifies financial health. Dividends do have tax implications. Dividend payouts will satisfy current investors, and it also has the potential to attract new investors. The asymmetric information of dividends signals future expectations of continued growth and health. Dividend reduction or cuts could signal negative financial health, therefore signaling as a result of dividend payments is something that should be avoided unless you can continue to pay those dividends. Repurchasing of shares signals the stock is undervalued, and firms just are not likely to purchase stock that's overvalued. In summary, we've provided a Wrigley background on the company. We've talked a little bit about the Aurora Borealis LLC with active investor strategist. We've talked about the capital structure decisions at play, and wrapped it up with some of the financial principles and procedures in regards to capital structure. Thank you.